Lisa, what's your main takeaway so far?
There wasn't a massive reaction in the bond market. The little bit of a reaction that you did see was actually a little bit of a tempering of the sell-off. People kind of ratcheting back their expectations. I mean, the data really showed moderate growth, which is not consistent with some kind of rapid, sudden inflation. It kind of made people say, all right, it's going to be okay.
Far from it, in fact. Carl, we described the Fed's Beige Book as anecdotal data that's used to supplement the hard data that's already been released. Does the FOMC actually include Beige Book in its dashboard? Does it take it into account?
Oh, absolutely. They're very focused on these anecdotal reports. So there's theory and there's reality, and this provides more of the latter. So they focus on this. There's two things that really caught my eye here. First of all, the retail anecdotes generally showed activity improving across the region, and this stretched into late May.
Even as the spending numbers showed no
Exactly.
change.
So retail sales were somewhat disappointing. The consumer spending numbers earlier this week were on the soft side. It looks like a lot of that spending is going into services, and there was lots of mention here of the early Easter holiday potentially pulling sales into March out of April. So retail was one thing that caught my eye, and the second thing was the manufacturing figures, because we've been in this manufacturing soft patch for really 2 quarters now. This shows that activity's lousy in the Dallas Fed District, the Kansas City Fed District, but elsewhere it shows that factories are regaining traction. And these are both important developments in an economy that was in contraction in Q1 and posting to date, a relatively modest rebound in the current quarter.
Lisa, our Chief Washington correspondent Peter Cook, he summed up like this: no sign of the slowdown we saw in the first quarter, but he said not an economy that's racing forward either.
Exactly, which raises questions. Why are we getting this tantrum in bond markets right now? I mean, you're basically seeing 10-year at the highest level since November. You're seeing the 30-year similar kind of reaction. You're not seeing some kind of massive inflation. Yes, there has been a rebound in oil prices, but it hasn't been so dramatic in the past couple of weeks. Especially because the economic fundamentals are, meager. I mean, they're marching along. We're not seeing maybe a contraction, but they still cited the stronger dollar as hampering some of the growth and some of the manufacturing. This isn't a gangbusters economy.
So it's not the economy that's pushing bonds to fall like they are right now, Carl.
It's the international economy.
There you go.
I think it was the comments from Draghi earlier today suggesting that they wouldn't be modifying the pace of quantitative easing in Europe, because potentially if Europe's ramping up QE, that's going to push yields down across the board in Europe and in tangential markets like the U.S. If they're not doing that, then all else being equal, that would suggest that rates could be slightly higher, not significantly higher.
Although they're not. I mean, they're continuing the pace. I mean,
well, we're at about
they're not backing away. Yeah,
we're at 2.35 now on the 10-year yield, so that's higher than we've seen recently.
No, I'm saying that Europe is not backing away from its stimulus. So why are people flipping out? Yes, you saw inflation a little bit coming up, and I think people basically are recalibrating and saying, wait a second, we're not going to get deflation.
And even Mr. Draghi saying today, it's working.
Exactly.
Right.
So
it's clearly working. The issue was that maybe the ECB was going to actually accelerate purchases around the timing of all of these Greek negotiations getting settled. That clearly is not the case.
Do we get any clearer sense of economic direction from the Beige Book or from this week's data so far, or do we need to wait for the May jobs report to determine that for us?
Well, we get a little bit of clarity, but certainly not enough. So we know that, the economy is moving forward at this lackluster pace. Everyone says Goldilocks. It's more like the porridge than Goldilocks. I think mushy and kind of unimpressive. But really the jobs data are where, the proof in the pudding, again, to use the porridge analogy. But the point is, June is off the table at this point. The Fed is not going to rush to raise rates. So jobs report actually becomes a little less important now as we recalibrate towards potentially September.
And Lisa, we'll let you get the last word in here.
Well, I think the bond market right now is, as you say, responding more to Europe. And so there's a question of whether an economic data point from the U.S., especially having to do with jobs rather than wages or other inflation gauges, will really have some kind of dramatic effect on the market. Because right now the focus is on inflation. Okay,
and before you go, just quickly, speaking of dramatic effect on the market, the deadline for Greece is Friday. Here we go again, another 11th hour thing. What gets done? How are the markets going to react on Friday?
Well, there certainly will be, a risk-off mentality as we approach that date. I'm not so sure that Friday really is the date as, we get to these deadlines and blink and the goalposts move and whatnot. The important thing to remember is this. Support for the Tsipras government has actually deteriorated in Greece. The majority of Greeks want to stay in the Eurozone. So sooner than Greece exiting might be the exit of the current government.